So the next section is recognition of deferred taxes. So when do we recognize a deferred tax liability? Because we've mentioned it now, but when do we recognize it? So paragraph 15 says, a deferred tax liability shall be recognized for all temporary differences, except when it relates to the two things outlined below. One, it could be goodwill, or it could be items when they were what? When they were recognized, they didn't impact P&L and they didn't impact taxable income. So if you got such an item, then it is also going to be what? So let's just clarify. Recognize deferred tax for everything, okay? Except for what? Except for items at goodwill, like goodwill, and what? And items whose when they were initially recognized, they did not impact the P&L and they didn't impact the what? The taxable income. So there's a difference, but that difference did not impact P&L or it did not impact taxable income. If that's the case, what do we have? We have a general exemption principle applying. We have a general exemption applying. And every time you've got an item for which you don't provide deferred tax for, what do? You consider that to be an exempt difference, and it becomes part of the tax recon, which is something we're going to talk about. Then the accounting for the tax effects of a transaction is of the tax effects of the is consistent with the accounting for the transaction itself. Meaning that if the item goes to P&L, deferred tax should follow in P&L. If the item goes to equity, deferred tax will follow in equity. If the item goes to, what do you call it? If the item goes to OCI, deferred tax will follow to OCI. So just be mindful of that. Then we've got an example here. An entity acquired a new asset at a price of 120,000. The useful life is 3 years. SARS has indicated that it will not grant the entity any tax allowances on that asset. Ooh, bit harsh. 50,000 was spent on the development of an intangible asset. The intangible asset has a useful life of 2 years, while SARS grants 100% deduction when the company has incurred that expense. Okay? An entity acquired the business of another entity. Goodwill amounting to 700,000 arose from that acquisition. So calculate the deferred tax liability or asset for each of the item as at 31 December 2020. The corporate income tax rate is assumed to be 30. So now let us go for it. So LE3, the exemption principle. So we have, they just call it a new asset. So at the beginning of the year, this asset did not exist. So it was acquired at 120. Then, is there any depreciation that is expected on this asset? Yes, so that means we do that. What about the tax base? Are there any deductions that we are expecting? No. Why? Because SARS does not allow any wear and tear allowances. All right, so that is what we have. Okay, so then we have depreciation, because they said the asset is depreciated over 3 years, so depreciation is 40. Then the carrying amount will then be what? Will then be 80. But SARS has what? Has 0 because they don't give allowances. So SARS does not have any allowances because they don't give any allowances. So we've got what? We've got an amount of 0. Okay. No allowances granted. So now we check whether the exemption paragraph applies. So remember, we check it at initial recognition. So at initial recognition, was there a temporary difference? That's test number 1. Was there a temporary difference? The answer is yes, there was, because we had 120 and 0. All right, then this is exempt. Hold on. Before we make it exempt, so this is, we are checking. Should we provide deferred tax on this? So deferred tax should be provided on all temporary difference. So based on this view, we are saying that the answer is what? Is yes. Then we say, hold on, we need to check, except to the extent. So they've got an except to the extent. Is it goodwill, this amount? No. So far we are fine. All right. Did it arise on initial recognition? Did it arise on initial recognition of an asset? Yes. Then was there an amount that impacted P&L? Was there an amount that impacted P&L? No. Depreciation was recognized at a later date. Remember, we are at initial recognition. Was there an amount that impacted taxable income? Was there an amount that impacted taxable income? No. So therefore, this is what? This is exempt. So this difference is exempt and no deferred tax to be provided for. So no deferred tax to be provided for. Makes sense. So did you have a difference? Was there a temporary difference on initial recognition? Yes. Oh, no. Yeah, on initial recognition. Yes. What do you do on all temporary differences? You recognize deferred tax. All right, but is it goodwill? No, it's not. So it's still fine to recognize deferred tax. But was it on initial recognition? Yes, the difference recognized will accrue on initial recognition. Did it impact P&L? No impact on P&L, so no. Did it impact taxable income? No impact on taxable income, so no. Therefore, it means that this is exempt. So the trigger is it occurring at initial recognition. So why is it important? Because if it is initially exempt, it continues to be exempt. So that is why we don't have any further deferred tax consequences. Then the second asset is an intangible. What did they say? They said that we spent 500,000 on the development. So that means we had 500,000 or 50,000. And that is our carrying amount. The tax base is 0. Why? Because there are no future deductions. Why? All deductions granted immediately. So in future, there are none. So we talk about future on day one. Oh, all right, I'm with you. So now, did this happen on initial recognition? Did this happen on initial recognition? Yes. Did it relate to goodwill? No. Did it relate to on initial recognition? So is it a temporary difference on initial recognition? So temporary difference. Yes, it was on initial recognition. Did it impact P&L? No. Did it impact taxable income? Yes. So therefore, exemption does not apply. So when does the exemption apply? It applies if it impacted neither the taxable income or profit or loss. But in this case, it impacted the what? It impacted taxable income. So therefore, on this difference of 50, provide for deferred tax at 14,000. And then going forward, it means that you will then say amortization, and you will divide by 2 to then do what? To then be left with that. And then for SARS, so this will be the carrying amount. For SARS, is still 0 and 0, meaning that the movement in temporary difference, what do you call this? Temporary difference. So the movement will then be this minus this. So that will be the movement for the year. Or not so much, because this was not at the beginning. Opening balance. Okay, so that is what we have. Then the next one is goodwill. So carrying amount of goodwill, it is 70,000. What is the tax base for SARS purposes? So SARS does not give any deduction for goodwill, so that's 0, no future deductions. So is the difference arising? Is the difference? Is there a temporary difference? Yes, but is it goodwill? Yes. So what is the outcome? If it is goodwill, it is exempt, because we recognize deferred tax on all the item, except what? Except for goodwill and item who on initial recognition did not impact the P&L or the taxable income. So it is a very interesting test. A very interesting test. So please just revise it and make sure that you are aware of it. So I've seen that in most of the questions, they don't emphasize it as much, but come CTA, ITC, you need to be a master of it. So that is that. And we are done with this example. So let's return to the slides. So when it comes to the next section deals with capital allowances. So capital allowances, just to clarify, are those wear and tear. They are an equivalent of depreciation for accounting purposes. These amounts are therefore deducted when determining taxable income. And there are some assets, as we've just seen, where SARS is saying, no, there are no allowances. Things like land and other specifically identified assets. Then what happens on disposal of assets? On disposal of assets for which capital allowances were granted, SARS will want their capital allowances back. And they call that a recoupment, because it's like you bought an asset for 100. Then I said, let me give you a break. As you're busy using it, I will reduce. Let's do this. Let's assume what? Let's assume that it is a vehicle. You bought a vehicle. Then SARS says, oh, as you use the vehicle, I'll give you a break on your tax over the next 3 years. I'll allow you to deduct the cost of the asset from your income. So they are recognizing that you've incurred a cost to generate this income, and they want to help you. But if you sell the asset after they've given you the deduction, it means that you will likely recover a portion of the carrying amount. If you recover a portion of the carrying amount, SARS will say that, but some of that amount I had already given you as a deduction. So it's a bit confusing when you are now what? When you are now recovering. So it is a bit confusing when you are now recovering. So I want my allowances back, because essentially that asset didn't cost you anything, since you were able to do what? Since you were able to recover a portion of it. Then the recoupment, as you can imagine, it will be limited to what SARS had given you before. So you cannot have allowance of 10,000 and SARS says they are recouping 20,000. It doesn't work that way. You can only recoup what SARS gave you. So the formula that they have for calculating recoupment, it ensures that. And it ensures that the allowances, since they are based on the asset, so it ensures that the recoupment should never exceed the asset. Then someone thought about it and say, but what if I'm actually recovering more than what the asset cost? Any portion above the recovered cost is referred to as a capital gain. It is referred to as a capital gain. So think with me here. So what I'm saying here is that if I buy an asset for 100 rands, for 1,000, and I have wear and tear of 600. So that will then be what? That will be then 400 tax value, tax base. So if I sell an asset and I sell it for 900, SARS will say, oh, you recover some of the portion. So you have recovered the selling price of 900. And I was left with 400 more allowances to go. Or after deducting the allowances in the past, I was left with 400. So that means I need to what? To recoup the amount that got it to 500, to 400. And that amount is what? 500. So in your allowances that I've given you of 600, it seems that what? It seems that 500, you have recovered it. And that is why there is a recoupment of 500. But what if you sell the asset for 1.2? So SARS will say, I want to recoup based on the selling price, but I cannot exceed the cost. So I then limit this to what? To 1,000. And then I say what? 400. And this will then be my recoupment. But I did receive 1.2, but it seems this calculation is limiting to 1,000. How do I deal with the 200? Then I need to then say the selling price of 1.2 minus the cost of 1,000. This will then give me what? This will then give me what we call a capital gain of 200. So this will then give me what we call a capital gain of 200. So what are we getting from here? We are getting that you cannot recoup more than what you were given. That's one. Number two, anything that is above, or a portion of the selling price that is above the cost of an asset, it will trigger a what? A capital gain. Why is this necessary? Because in South Africa, capital gains are taxed at an 80% inclusion rate. Whereas what? Whereas, so that then is the tax. Whereas this recoupment is taxed at 100%. So as a result, there is a need to do what? To do the split. So that is what I want you to be aware of. And that is what this slide right here was communicating. Okay. So let's look at the next example. So on 1 Jan 2019, CA Limited acquired a new vehicle at a price of 120. The useful life of the asset is 5 years. SARS has indicated that it will grant CA Limited tax allowances on the asset over a 3-year period. On 31 December, CA Limited sold the asset for 100,000. So will there be a recoupment here? Yes, there will be, because you are selling an asset. But also the recoupment will need to be a above the current tax value so that you recoup any amount above the current tax value. But we'll need to check. So maybe here the answer is possibly. Then will there be a capital gain? Remember, capital gains only arise when the cost of an asset or the selling price of an asset is more than the cost of the asset. The cost of the asset is 120 and the cost of the selling price is 100. So we don't expect any capital gain. The second one says on 1 Jan 2019, CA Limited acquired a piece of land at a price of 200,000. On 31 December 2020, they sold that land for 350. Did they have any allowances? No, land does not have any wear and tear. So we are recouping 0. Is there a capital gain? It seems that the land is sold above its original cost. So yes, there is a capital gain implication. The last one, on 1 Jan 2019, they acquired a new building at a price of 600. Useful life, 5, and allowances over a 3-year period. On 31 December, that building was sold for 700,000. Is there going to be recoupment? Yes. And what about capital gains? Yes. Why? Because the price of 700 exceeds the original cost of 600. In the year ended, before those transactions are taken into account, the profit generated was 1 million. We are required to calculate the profit before tax and taxable income, which includes the effects of the transaction above. The corporate income tax rate, 28%, and the capital gains tax inclusion rate is 80%. So let us deal with that. So where do we start? I start with my assets. I start with my asset. So I've got the vehicle. The vehicle, let me put like this, and the temporal difference here. So it was acquired in 2019, 120, 120. Then wear and tear allowances, they are over a period of 3 years. So this will then be, let's do this. This will then be year 1, 2020, 2019. Then depreciation is over a period of 5 years. Then year 2, what do we have? We have 2020 and depreciation and wear and tear. Okay. So let me just total it up. Okay. So that is how this picture looks like. So then if we look at this, so the carrying amount and the tax base, they amounted to 96 and 80 last year. And this year it's 72 and 80. So we had, so this will be the opening balance. And this will be the closing balance. So we will then have what? We will then have 96 minus 80 and 72 minus 40. So that will be our temporary difference. All right. Then when it comes to the land, we then pick up what? We then pick up that the opening balance will have then been originally, or there was an acquisition and we had 200,000 and there were no future deduction. And this occurred at initial recognition. It was not goodwill, and it neither impacted profit or loss or taxable income. So this difference here is exempt. Then we finish off with what? With the new building. So the new building will follow the structure that we did here. So the building cost us 600,000. For SARS, it's 3 years. For accounting, 5 years. Happy. And that is what we have. So now we are saying, how will then the disposal of these assets look like? So we've got this. So let me just highlight. So we've got this. And now we are saying that what would be the impact then of this, of the disposal of these assets on profit? So let's then have profit before tax. And then we have the amount given as R1 million. And then what are we saying? We have the vehicles. So what is the profit? So it will be the selling price. So let me just create another column here. So it will be the selling price of how much? Of 100,000. And the carrying amount will then be the 72,000. So that means the profit on the disposal of the vehicle will be 28,000. Done. Then for land, same thing. Selling price was given as 350, but carrying amount 200,000. So done. Then I've got buildings. And then with the building, we have selling price of 700,000. But what is the carrying amount? The carrying amount is 360. So that will then mean that the adjusted or the corrected profit is 1.5 million. So that is where we stand. Then from a taxable side perspective, we start with the same 1 million, but it's important to determine whether we are looking at a recoupment or whether we are looking at a capital gain. So let me just add another column. So we will then say that is this for the vehicles, the selling price limited to the cost. But this is not a problem because the selling price was below the cost. So this is fine. But the tax base will now be how much? Will now be 40. So that means the recoupment on the vehicle is 140,000. So it's 140,000, and that is the recoupment. And let me do this. So that will then be the recoupment. Then on the land side, there are no allowances to recoup. So everything is what CGT, capital gains tax related. So then I've got what? I've got a recoupment of 0. And now I need to do what? I need to do a capital gain. So the capital gain will be the what will then be the selling price minus the cost of the asset. And that will give me what? That will give me 150. But only what? Only 80% of the 150 is taxable. Okay. Then with the building seems to have both. So the building seems to have both. So we will then, so this is actually the tax base. We will then say, let's start with the recoupment. So the recoupment will then be the selling price limited to the cost of the asset, which is 600,000. And the tax value of the asset will then be what? 200,000, meaning that SARS is essentially recouping 400,000. Is it in line with the allowances that they had provided us before? Yes, that is it, 200,000 and 200,000. So we recoup 100% in profit. Then when it comes to the capital gain will then say the selling price compared to what? To the cost of the asset. And that will give us a capital gain of 100. But how much do we include? We include only 80,000 of that amount. So notice the difference between where accounting is at and where tax is at. So accounting is sitting with 1518. That's right. So accounting is sitting with 1518, and here it's sitting with what? 1740. So if someone then says, explain why that is, how will you then be able to reconcile? So now let us do our profit before tax. Our profit before tax adjusted for this, it's 1.5. Then what is the movement in deferred tax? The movement in deferred tax. So the movement in deferred tax, or temporary difference rather, in taxable temporary difference, if we think about it, we had the vehicle, we had the land, and we had the building. And then the vehicle opened with 16, then the building was 0 because it's exempt, and the land was 0 because it's exempt, and the building was sitting with what? With 8. Okay. So in total, it was 96. But at the end of the year, so this was the opening taxable temporary difference. So closing, because all the assets have now been sold, so that means the closing is 0. So that means the taxable temporary difference was 96. Now it is 0. There is nothing left to defer. So that will then result in a movement of 96,000. So movement of 96,000, we still see that it is a bit short. So it means that the reason why those two are different cannot be fully explained by the deferred tax. But we then know that, all right, there were those items or those portions that were disregarded. So they must have been in here because we don't disregard anything, but here they were disregarded. So let's look at the items that were what? Disregarded. So capital gain, not taxed. So we started with the one for land. For land, it was 150 times what? 20%. Okay. Then we had the capital gain of 100, not taxed as well. So we had 150 times 20, 100,000 times 20. So these were the amounts that were not taxed, right? All right, so then this will then be minus and minus. But before we make it equal to this, here we are just focused on what? We are just focused on the sales. We need to bring in the depreciations. So let's just bring them in because they will impact our answers. But we're just bringing them in to reconcile. Depreciation on the vehicles, 24, depreciation on the building, 120. So this will then be so much. Then here we'll then have wear and tear. Wear and tear on the vehicles and wear and tear on the building. So on the vehicle, we have 40, and here we have 200. So we bring them down as well to 56, okay? So, so then what are we sitting with? We are sitting with 1374, and it needed to add up to what? It needed to add up to 1.5. What am I missing? Let me quickly check. Okay, so it was this brackets here. Okay, so if you check, this balance is off. So I want to then introduce a very interesting concept here. So what are we seeing? We are seeing that, all right, to get to profit before tax, we had the vehicles profit and depreciation there. For land, we had the profit on disposal of land there. Then we have the building profit on disposal and the depreciation, giving us a profit of 137. Then we have profit before tax on the other side. So we are not doing add back because we were seeing that that had not taken into account the adjustment or the transactions above. So we then have vehicles, which then had only a recoupment of 60,000. And we had land, which had a recoupment of 0, but a capital gain of 120, after disregarding 30,000 in the 150. And for building, we had a recoupment of 400,000 and a capital gain of 100,000 of 80,000 after disregarding 20. And we provided for wear and tear, and this gave us so much. But from an exam perspective, we don't have time to do all this. What they want from you is this box right here. So how do we then do it? We start with the profit before tax from an accounting perspective. Then we do the movement in taxable temporary difference of 96. This then being the opening balance of temporary difference compared to the closing balance. All the assets were sold, therefore, meaning that the entire amount that was opening is the movement. Then we saw that it was not equaling the 1420. Then we remembered that it was due to those portion of capital gains not taxed. So in other words, there is no deferred tax implication on this. So there is no deferred tax implication. Why is that important? This is important because this then is shown separately from this number right here. Because remember that this number right here is going to be multiplied by 28 and form part of the tax expense for the year. But if there are these items down here, it means we expect then to be a difference that deferred tax cannot explain. And that brings us to our next section, which talks about what? Which talks about the tax reconciling note. So the tax reconciling note helps us to explain why the tax expense we are expecting is not the same as the one we are calculating. Why the tax expense we are expecting is not the same as the one we are expecting. So if we think about it, in the previous example, I did raise that the tax expense is current tax plus deferred tax. And we saw that that was equal to the tax expected. So that was fine. But now if we apply the same principle here, I will then say that the current tax, it's this multiplied by 28%. And the deferred tax will then be this multiplied by 28%. So that will be the tax expense for the year. Okay. But when we do it, when we do our expected tax, we will then say profit of 1374 multiplied by 28%. And we are saying, unlike the previous example, things are not looking as nice. There is a difference. So we need what we call a tax reconciling item, a tax reconciling note, to explain why there is a difference to the tax that the users of the financial statements were expecting and the one that we are reporting to them, because there is a difference and someone has to know why. So a tax reconciliation note, its primary objective is to do what? It is to bring those concepts together. So what are we saying here? We are saying that you will then have to prepare that tax record and say that this is the tax you were expecting, and below is the tax I've calculated for you. And the difference between the two is as follows. So that is how a tax reconciling note works. So to clarify why it is necessary because there are items included in profit before tax that are income but are not taxable, or they are exempt from income tax. This is dividend income, specific government grants, as well as that portion of capital gain that we just saw and we are disregarding. And from an expense perspective, it could be fines and penalties and any items that we've already discussed under paragraph 15. So those will then be your goodwill, for instance. So those kind of things are not what? Are not going to give rise to deferred taxes. And therefore they need to be explained through a tax reconciling note. So if I'm to do it here, I will say that I had an accounting profit. So it works with, you tell the user that the users, I had an accounting profit of 1,374,000. And the tax on the accounting profit at 28% is how much? Is 384. But the one I'm reporting to you, which is normally called the effective tax expense, it is what? It is 377.20. So there is a mismatch. So there is a mismatch. And then if there is a mismatch, how does that work? So we know that there are items of gains and losses included in here, but that are exempt. And we have noted them to be what? To be as follows. So we have noted them to be as follows. So we will then need to take those gains that were disregarded and show their tax effects. Show their tax effects. So we then come and say 30 multiplied by 28. And if you then check what this comes to, you will find that the users are saying, oh, I now see why the tax I had expected was not materializing. It is because there are these gains and losses that are what? That are included but are not taxed. So when you removed them, then it meant that deferred tax couldn't provide for them and they needed to be explained separately. So the tax recon will step in where deferred tax cannot assist. And as I said, I've made an example of those. So the test is deferred tax applicable on those items? If the answer is no, then you don't need to what? You don't need to worry about it. Okay? Then let's look at what? Let's look at this example as a concluding part of this section. So we've got CA Limited with a year end of 31 December. During the year ended 31 December 2020, they generated profit before tax of 950. Included in profit before tax is dividend income of 120 and an expense of 30,000 relating to the impairment of goodwill. Dividend income is exempt from South African income tax. The deferred tax balance, that is a liability, was 117,600. And last year it was 95,200. The tax rate is 28%. So what is the accounting profit before tax for 2020? So what is the tax on it? So what is the tax on it? So we will then say that the accounting profit before tax, it's how much? It's 950. And the tax on it, it's what? It is 266. Okay. Then this is part A. Part B, what is the tax expense? Remember, the tax expense includes what? Includes current tax and deferred tax. All right, so current tax, we then say that we will start with profit before tax. And we see that there was movement in the liability. So deferred tax liability. So deferred tax liability, how much is it? We've got opening. So we've got opening of 95,200 and closing of 117,600. And what is then the tax, the temporary difference? So we can just divide divide by 28%, because we know that the deferred tax is just an answer after multiplying by 28%. So as a result, we then divide and we get 340. So the movement will then be 420 minus what? Minus 340. Or otherwise, you can just do the movement on the liability, and this will be the deferred tax or income tax expense. And then here, this will be the movement in temporary difference. All right. Then what do? We then have here profit of 950. And we bring what? We bring the movement in temporary difference. So here we bring in the movement. So the movement in temporary difference, it's 80,000. Remember, we deduct it here because it's going to be taxed in future. And that gives rise to an expense of what? Of 2240. Then we have the exempt differences. Like what? Dividend income. What is dividend income? The dividend income is 120. And why are we removing it? Because it is not taxable in SA. And then we have an impairment of goodwill. Because goodwill is exempt, it means that the impairment of goodwill is also an exempt item. So we remove it because it is also an exempt item. Okay, so this then gives us taxable income. So this gives us taxable income of 78. And this is what? This is 218,400. So as a result, we have current tax of 218,400. So these two are then what we are looking for when we were asking about the tax expense for the year. So we have a problem. The current tax expense and the tax expense on accounting profit are not talking to each other. Where the items that deferred tax did not help us to reconcile. Yes, there were these exempt differences. So there was the dividends income and there was an impairment of goodwill. So let's clarify this. So do you agree that these amounts are in the 950 and therefore they are taxed in here? But we just removed them when we were determining this. So in order for me to move from this to this amount also have to be removed. So I then say that it will be the dividends income multiplied by 28%. And the impairment of goodwill multiplied by 28%. So if I then check, voila, it explains to me why the two were not talking to each other. So the users of the financial statements are now understanding why they were not talking to each other. So what is then the idea here? The idea is that you need to zoom in your understanding of where you are going and consider where you are coming from. And that is how you will then be able to master a tax reconciling item, a note. So that is how the note works. And can you see that it's starting to build up now? It's building up. We were integrating our calculation of tax with these new elements now. So it's the basics that you need to get right. So please work through those basics. As much as it takes time, it will be an invaluable time into what? Into your development. Then, where are we? Yes, so here is that movement and so on. So I trust you are right. So the last one, they said prepare the tax recon in rands. So this is it in rands. But interestingly, they said also in percentage. So how do we do it in percentage? We express everything here as a percentage of what? As a percentage of the profit. So I then say this divide by the profit. And it will be how much? It will be 28. This by the profit, this by the profit, this by the profit. So as a result, it then looks what? It then becomes this. So when someone asks, what is your effective tax rate? It is the tax expense divided by your accounting profit before tax. We expected it to be 28, but we see dividends reduced it by 3.5, impairment increased it by 0.9, and we landed up at what? At 25.3. So that is how the tax recon looks like in percentage. How do you do it? You just divide by the accounting profit that you used. So that is how it works. So if they ask for the one in percentage, that means you will need to do this first, but after you are done, divide everything by the accounting profit before tax. So that concludes this section on recognition.